Welcome to Breaking News to Trading Moves. Picture, 1,600 defense and aerospace companies just gathered on the tarmac in Farnborough, England.
Oh, yeah, we're talking, sprawling corporate chalets, roaring jet engines overhead.
Smell of jet fuel everywhere.
Exactly, and executives in tailored suits boasting about billions of dollars in new orders.
Right, it sounds like an absolute boom. But behind closed doors, well, it's actually a supply chain nightmare. So today we are examining this breaking headline about the Farnborough International Airshow opening to record attendance.
Yeah, breaking historical records, actually.
And our goal for you, the listener, is to clearly identify the specific market winners and losers. We really want to separate the daily noise of these flashy announcements from actionable trading takeaways you can actually use.
Right, because those 1,600 exhibitors, they're battling over two very distinct areas of capital. First, you have commercial aircraft orders where airlines are trying to secure their future fleets for the next decade.
Yeah.
And second, accelerating global defense spending, which is driven by rising geopolitical tensions.
So our mission today is to look at exactly how those two themes dictate the balance of demand versus execution for very specific companies. It's really about figuring out who is just talking to the press and who can actually build and deliver the hardware.
Let's start with that first theme, right? The commercial order book versus the delivery reality.
Because Boeing and Airbus are fighting for a little over 300 aircraft orders at this show.
Which is actually on the lower side.
Right. Historically, Farnborough has been a stage for massive headline-grabbing fleet purchases. Decades ago, you would see airlines buying hundreds of planes in a single afternoon.
Just engaging in a very public tug-of-war between the major manufacturers.
Exactly. But this year, total numbers might fall below optimistic forecasts, and the mood is decidedly more cautious. Why is that?
Well, the potential shortfall is entirely driven by production constraints. The aerospace industry is battling severe, chronic bottlenecks with engines, specialized components, and overall supplier capacity.
I mean, we are talking about raw material constraints, right? Like titanium shortages.
Yeah, titanium is incredibly difficult to acquire and forge, but it is entirely necessary for modern airframes.
Because of its strength-to-weight ratio.
Exactly. You just can't build these planes without it.
Yeah.
And combine that material shortage with the persistent lack of specialized aerospace machinists post-pandemic.
Because the industry lost thousands of highly trained workers to retirement.
Exactly, or career changes.
Okay.
And you cannot simply replace a master machinist with a new hire in 6 weeks.
No, definitely not.
So you can't assemble a modern commercial jet if you're waiting on precision engine fan blades or landing gear forgings. The entire assembly line just grinds to a halt.
It's like a wildly popular restaurant bragging about a line of hungry customers winding around the block, but the kitchen inside is completely out of ingredients.
That's a great way to look at it.
And worse, the restaurant already took out a high-interest loan to build a massive new dining room they can't even serve food in.
Right. The demand is obvious, but an order just supports the backlog.
It only creates actual cash flow when the aircraft is physically built, certified, and delivered to the customer. So knowing the kitchen is out of ingredients, how does this reality change what traders should actually monitor when they read these headlines?
Well, traders need to stop staring at the raw order numbers flashing on a screen. For manufacturers, improving production and delivery times matters much more than announcing an intent to buy.
So what should they look at instead?
You want to look at specific financial indicators. Go to the earnings call transcripts and hunt for the book-to-bill ratio. That tells you the ratio of orders received to units shipped and billed.
A ratio above 1 means demand is strong, right?
Right. But if the backlog is growing rapidly while the billing remains stagnant, the company is just stockpiling IOUs. Watch for delivery schedules, production targets, and specifically supplier commentary.
Yeah, if a CEO spends half the earnings call complaining about a lack of raw materials or specialized labor, that raw order number is essentially meaningless to near-term cash flow.
Exactly. If Boeing can't get engines, they can't deliver planes.
Let's look at the specific winners and losers on the commercial side then. Starting with the commercial aerospace winners, this puts a massive spotlight on Boeing, ticker BA, along with GE Aerospace, ticker GE, and RTX, ticker RTX.
Yeah, Boeing stands to gain from the baseline demand for commercial jets, assuming they execute their manufacturing turnaround and satisfy regulators.
Right, but GE Aerospace and RTX are in a highly advantageous position because they have heavy exposure to engines, components, and servicing.
Right, the aerospace engine business operates on a razor-and-blade model. They often sell the initial engine at a loss or break even.
Oh, wow, really?
Yeah, and then they make their profit on the maintenance and spare parts over the 30-year lifespan of the engine.
That makes sense.
So even if new planes aren't rolling off the line as fast as expected, the existing global fleet desperately needs parts and maintenance. Those older engines require constant overhauls.
So what is the strongest bullish signal for these specific names?
It's clear evidence that their aftermarket revenue is climbing while their new production rates rise without facing new delays. Watch how the stock trades relative to its 50-day moving average on the day a supply update is announced.
Okay, so if it holds above that line on bad news, the market is telling you the aftermarket strength is making up for the production delays.
Exactly.
The market can be unforgiving, though. Those exact same aerospace names could easily become losers if the orders disappoint. We're talking about Boeing, ticker BA, GE, Aerospace, ticker GE, and Howmet Aerospace, ticker HWM.
Yeah, I would caution traders to watch those names closely for sudden downside pressure. These companies could see short-term selling if firm orders fall below expectations, or if management commentary highlights persistent bottlenecks.
They remain long-term beneficiaries of global air travel demand, sure, but elevated expectations create immediate downside when announcements fail to impress the market.
Right. If traders price in perfection and management merely mentions a minor supplier delay regarding a specific alloy,
Right.
the stock reacts violently to the delay. The market will entirely ignore the multi-year backlog and sell off the stock based on the immediate hit to quarterly free cash flow.
Well, let's follow the bottleneck down the runway then, because the manufacturers aren't the only ones taking a hit here.
No, definitely not.
We have to look at the airlines heavily exposed to delivery delays. We're looking at Southwest Airlines, ticker LUV, Alaska Air Group, ticker ALK, and American Airlines, ticker AAL. But let me push back on the severity here.
Okay, go for it.
Exactly how badly does a missed delivery schedule hurt an airline's daily operations? I mean, is a 6-month delay really causing structural damage to a carrier's balance sheet, or is it just a scheduling headache?
Oh, it causes a tremendous amount of operational and financial damage. It's far more than a scheduling headache.
Really?
Oh, yeah. When manufacturers miss delivery schedules, airlines are forced to retain their older legacy aircraft. And older aircraft require a steep increase in maintenance spending just to stay certified for flight.
Like the mandatory heavy maintenance checks.
Exactly. Often called C checks or D checks. And a D check requires completely dismantling the airplane. I mean, down to the metal shell, just to inspect for structural fatigue, corrosion, and wear.
Oh, wow. Literally down to the metal.
Yeah. You have to fly the plane to a specialized hangar, pull all the seats out, and inspect miles and miles of wiring. It pulls the plane out of service for weeks and costs millions of dollars per aircraft.
So you lose the revenue of the plane flying, and you pay a massive labor bill on top of that.
Right. Furthermore, those older planes burn much more fuel, meaning the airlines operate less efficient fleets in an environment with volatile jet fuel prices.
Which creates a compounding problem.
Very much so.
Large orders announced at a show like Farnborough might actually worsen investor concern if those backlogs grow faster than the manufacturer's production rate.
Because it tells the investor the airline is going to be stuck flying expensive, old, gas-guzzling equipment for much longer than anticipated.
The market sees a headline about a 50-plane order, but a smart trader sees 50 planes that won't arrive on time, forcing the airline to bleed cash on legacy maintenance.
And that compounding problem is an existential threat to the low-cost carriers in particular.
Right, which brings us to JetBlue Airways, ticker JBLU Frontier Group, ticker ULCC, and Southwest Airlines, ticker LUV.
Low-cost carriers operate on razor-thin margins. Their entire debt structure relies on the fuel savings and reduced maintenance costs of next-generation aircraft to pay for the leases.
Because legacy carriers have premium cabins, international routes, and business travelers paying top dollar to offset rising operational costs.
Right. Low-cost carriers do not have those levers to pull. Prolonged shortages in the supply chain make their capacity growth plans mathematically impossible.
They literally cannot expand their routes profitably if they are forced to run older, inefficient planes.
Exactly. The delay isn't just an inconvenience. It threatens the core mechanics of how they make money. They took on debt, assuming a 15% reduction in fuel burn from a new engine type.
And when that engine doesn't arrive, the debt payment is still due, but the fuel savings are completely gone.
Precisely.
Well, while the commercial side is choked by supply chain constraints, the other half of the tarmac is driven by urgent geopolitical demand.
Yeah, defense companies actually account for around half of the 1,600 exhibitors at Farnborough.
It's such a striking visual contrast. On one side, you have commercial airlines agonizing over delivery delays and maintenance costs. On the other side, you have military contractors rushing to fulfill orders for active conflicts.
That ratio of exhibitors tells you exactly where the capital is flowing right now. Wars in Ukraine and the Middle East have driven up immediate demand for specific military assets.
Like what?
Governments are issuing urgent requests for drones, missile defense systems, unmanned aircraft, and artificial intelligence-enabled systems. Farnborough serves as a very clear, very public signal for where global defense budgets are heading over the next decade.
We are watching a global rearmament cycle happen in real time.
Yeah, moving away from legacy hardware towards smart, autonomous systems.
Let's break down the winners in this space, starting with the defense primes and missile systems. The tickers to watch here are Lockheed Martin, ticker LMT, Northrop Grumman, ticker NOC, and RTX, ticker RTX.
These companies benefit directly from higher military budgets and the immediate demand for missiles, sensors, air defense, and combat aircraft.
So what are the catalysts to watch for regarding these specific tickers?
You're looking for new contracts and production commitments. Unlike commercial airlines waiting for planes to expand vacation routes, governments place orders based on urgent national security requirements.
That urgency often fast-tracks the funding and bypasses typical economic tight-fistedness.
Right. When a nation needs air defense interceptors to protect its airspace from incoming threats, they don't haggle, they don't negotiate over lease rates the way a commercial airline does. They write the check and they demand immediate production.
Within that defense umbrella, there is a specialized group of winners, the drone and autonomy specialists. The tickers here are AeroVironment, ticker AV, Kratos Defense, ticker KTOS, and L3 Harris Technologies, ticker LHX.
Yeah, these companies are highly exposed to unmanned aircraft, autonomy, communications, and battlefield technology.
And investors heavily favor companies in this space that can successfully combine autonomy with scalable manufacturing, right?
Absolutely. Modern warfare relies on these systems communicating with each other, forming autonomous networks.
But that scalable manufacturing piece is the entire ballgame. I mean, it's one thing to build a high-tech prototype drone in a pristine lab.
Oh, sure.
Surrounded by engineers, hand soldering every circuit.
Yeah, of course.
It is a completely different challenge to manufacture 10,000 of them reliably at scale for an active global conflict, especially where they need to operate in harsh weather and highly contested electronic warfare environments.
Right. The battlefield exposes every flaw in a supply chain. Investors know this. The companies that win the defense contracts over the long term aren't necessarily the ones with the flashiest prototypes at the air show.
It's the ones with the industrial capacity to deliver those systems in volume repeatedly without fail.
Yes. A highly advanced drone is utterly useless if the manufacturer can only produce 3 of them a month. The market rewards the defense contractors who have secured their own supply chains for microchips, composite materials, and secure communications arrays.
They need to prove they can scale production instantly when a conflict breaks out.
Exactly.
So we've covered the commercial traffic jam and the defense sector urgency. Let's synthesize this into a final playbook for you, the listener.
Sounds good.
The core question driving every trade around this event comes down to demand versus execution. The headlines will scream about demand, but your portfolio depends entirely on the execution.
Right. While demand for both aircraft and defense technology appears incredibly strong, commercial aerospace still needs to prove it can convert those flashy orders into actual physical deliveries.
Whereas defense stocks present cleaner near-term momentum strictly because military demand is supported by urgent geopolitical priorities.
Right. The funding is often already appropriated by governments, just sitting in a budget ready to be spent. Commercial airlines, however, are financing their purchases in a tight economic environment with high interest rates.
Yeah, a commercial airline order might be delayed or renegotiated if a recession hits. A defense contract for missile interceptors is far less vulnerable to macroeconomic cycles.
Very true.
So how should traders filter the daily announcements flooding out of the show? If you're looking to build a bullish and bearish checklist, what specific professional-level indicators go on it? Give us the exact markers to watch beyond the standard press release.
Well, for bullish trades, you want to watch for confirmed orders, fully funded contracts, documented production increases, and improved delivery targets. Look for hard numbers and specific timelines.
So pay attention to how a stock trades relative to its 50-day moving average on the day an announcement drops.
Exactly. If a defense stock announces a new drone contract and surges past technical resistance on high trading volume, that is a strong momentum signal indicating institutional buying.
And for bearish trades,
For bearish trades, watch for vague agreements like memorandums of understanding, delayed schedules, and unresolved supply constraints.
Because a memorandum of understanding is just a promise to keep talking. It is not a binding contract.
Right. Watch the implied volatility in the options market leading up to these announcements. If options are pricing in a massive move and the company delivers a vague timeline, the stock will get punished.
So the absolute best trades come from separating genuine revenue catalysts from flashy press releases that will take years to actually affect the company's cash flow. Ignore the noise, follow the cash.
That's it.
To recap, the Farnborough Airshow boiled down to who can actually deliver on their promises. We have established the distinct line between the winners and losers. Boeing and the major airlines face a steep uphill climb against supplier bottlenecks, while defense contractors and drone specialists ride a surge of urgent global demand.
That really sums it up perfectly.
But I want to leave you with a final thought to mull over as you watch these tickers move. If commercial manufacturers continue to push back delivery dates year after year, at what exact point does the rising math of maintaining an aging fleet completely break a low-cost carrier's business model? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.